Welcome back, everyone. Something extraordinary happened in early April of 2025, and its consequences are still echoing through every corner of the global economy. Markets that had been climbing steadily for months suddenly reversed course with a ferocity that stunned even the most seasoned investors. Trillions of dollars in wealth vanished in a matter of days. Trading floors descended into chaos. And at the center of it all stood one man whose decisions triggered what analysts are now calling the most dramatic market disruption since the depths of the pandemic crisis. Today, we're going to examine exactly what happened, why it happened, and what it means for the future of the American economy and your personal financial security. The story begins not with a single event, but with a series of decisions that build toward a moment of maximum disruption. Donald Trump entered his second term riding a wave of market optimism. Investors had pushed stock indices to record highs in the weeks following his inauguration. The mood was bullish, confidence was strong, but beneath that calm surface, forces were gathering that would soon collide in spectacular fashion. Trump had campaigned on promises to reshape American trade policy, to bring manufacturing jobs back to domestic shores, and to confront what he described as decades of economic exploitation by foreign nations. Those were not empty words. They were blueprints for action that would materialize with stunning speed and scope by late March of 2025. Financial markets had begun to sense that something significant was approaching. Trump had announced what he called Liberation Day, a date on which he would unveil sweeping tariff measures designed to reset America's trade relationships. The announcement itself created ripples of anxiety among investors who understood that tariff policies of the scale being discussed could fundamentally alter global commerce. Business leaders waited nervously. Economists issued warnings, and traders positioned themselves for volatility, but few anticipated just how severe the reaction would be when Liberation Day finally arrived. On April 2nd, Trump delivered on his promise. The tariff package he announced was breathtaking in its ambition and scope. A baseline 10% tariff would apply to virtually all imports entering the United States. Beyond that baseline, dozens of countries faced individualized reciprocal tariffs calculated based on their trade surpluses with America. The numbers were staggering. Some nations faced tariff rates of 20, 30, or even higher percentages on their goods. The policy represented the most dramatic shift in American trade posture in more than a century, and markets reacted with immediate panic. What followed was not a gradual decline, but a cascade. Stock indices across the globe plummeted as investors rushed to exit positions. The selling pressure was relentless. In Asia, exchanges opened to scenes of chaos. Hong Kong's benchmark index suffered its worst single-day collapse since 1997, plunging more than 13%. Taiwan's market recorded its largest one-day drop in history, shedding nearly 10% of its value. The damage was not confined to any single region or sector. Technology stocks fell, manufacturing shares tumbled, financial institutions saw their valuations eviscerate. Even traditionally stable blue chip companies could not escape the selling wave. The speed and severity of the decline caught many by surprise because it violated patterns that investors had come to rely upon. In normal market corrections, certain asset classes provide refuge. Bonds typically rise when stocks fall as investors seek safety. Gold usually attracts flows during times of uncertainty, but this time was different. Bonds sold off alongside equities. Treasury yields spiked in a manner that signaled deep unease about American fiscal. Simultaneous moves across multiple asset classes indicated something more stability. The dollar weakened despite its traditional role as a safe haven currency. This is more troubling than a routine correction. They suggested a fundamental loss of confidence in the policy framework governing the world's largest economy. The technical indicators told a story of extreme stress. The VIX index, often called the fear gauge because it measures expected volatility, rocketed to levels last seen during the early days of the pandemic when economies around the world were shutting down. Credit spreads widened dramatically as investors demanded higher compensation for holding corporate debt. Liquidity conditions deteriorated. Market makers who normally facilitate smooth trading pulled back, wary of the violent price swings. The machinery of global finance was straining under pressure that few had anticipated and none had adequately prepared for. Trump's response to the unfolding crisis was characteristic of his approach throughout his political career. Rather than expressing concern or signaling potential policy adjustments, he doubled down. He dismissed the market turbulence as temporary pain necessary for long-term gain. He compared the tariff policies to medicine that might taste bitter but would ultimately heal the patient. To critics who pointed to the massive wealth destruction occurring in real time, he offered reassurances that markets would soon boom and that this represented an opportunity for investors to get rich. The disconnect between his messaging and the empirical reality visible on trading screens worldwide created additional uncertainty. Investors struggled to reconcile optimistic rhetoric with portfolios bleeding value. The economic logic behind the tariff policies was rooted in a worldview that saw international trade as fundamentally zero-sum. In this framework, trade deficits represented losses that needed to be corrected through aggressive intervention. The tariffs were intended to penalize countries that had accumulated trade surpluses with the United States and to incentivize the reshoring of manufacturing capacity to American soil. Proponents argued that decades of deindustrialization had weakened the nation's economic foundation and that bold action was necessary to reverse that decline. National security concerns were invoked to justify the measures under emergency economic powers that granted the president extraordinary authority. But the immediate economic consequences told a different story than the one the administration was promoting. Tariffs function as taxes on imports, and those taxes are ultimately paid by consumers and businesses within the importing country. American companies that relied on global supply chains suddenly faced massive cost increases. Retailers warned that price hikes and product shortages were imminent. Manufacturers dependent on imported components saw their margins squeezed. Small businesses awaiting federal loans or permits found their plans disrupted by government dysfunction. The cumulative effect was a sharp increase in economic uncertainty that caused firms to delay investments, postpone hiring decisions and generally adopt a defensive posture. The revenue projections associated with the tariff regime revealed the scale of the policy shift. Estimates suggested the tariffs would generate more than $170 billion in additional federal revenue in 2025 alone. Over a decade, the figure approached $2 trillion. These were not trivial sums, but economists pointed out that tariff revenue came at significant economic cost. The same analyses that projected substantial revenue also forecast reductions in gross domestic product. The Penn-Wharton budget model, a respected academic institution, estimated that the tariffs would reduce GDP by approximately 8% and wages by 7%. For a typical middle-income household, the lifetime cost approached $60,000. These projections suggested that tariffs represented one of the most economically distorting forms of taxation available to policymakers. The international dimension of the crisis quickly became apparent as trading partners responded to American tariffs with retaliatory measures of their own. China, the European Union, and Canada all announced counter tariffs targeting American exports. The tit-for-tat escalation created a downward spiral in global trade volumes. American agricultural producers found themselves locked out of major export markets. Manufacturing firms saw overseas sales evaporate. Technology companies dependent on international markets faced new barriers. The retaliation was not merely symbolic. It targeted sectors of strategic importance to the American economy and imposed real costs on businesses and workers. China's response was particularly significant given that country's central role in global supply chains and its position as America's largest trading partner. Beyond imposing retaliatory tariffs, Chinese authorities suspended imports from certain American companies and implemented export controls on critical minerals and technologies essential for advanced manufacturing. These measures struck at vulnerabilities in the American industrial base, rare earth elements necessary for electronics production, specialized components for renewable energy systems, and other inputs suddenly became subject to Chinese government approval. The weaponization of supply chain dependencies highlighted the risks of economic confrontation between deeply integrated economies. As the crisis deepened through early April, voices across the political spectrum began questioning the wisdom of the tariff strategy. Democratic leaders seized on the market turmoil to attack Trump's economic management. They pointed to struggling families, disrupted businesses, and vanishing retirement savings as evidence that the policy was inflicting unnecessary harm. They raised concerns about potential insider trading, noting that policy announcements seemed to coincide with unusual market movements and questioning whether administration officials had profited from advanced knowledge of tariff decisions. Republicans faced a more difficult position. Many supported the broad goal of reshoring manufacturing and confronting China, but worried about the costs their constituents were bearing. The political pressure mounted as each day brought fresh evidence of economic disruption. The volatility that characterized April 2025 was unprecedented in its intensity and duration. Markets would plunge one day, rally the next, then reverse course again. The swings were not measured in fractions of a percent, but in multiple percentage points. On some days, indices moved 5, 7, or even 10% in a single session. This kind of volatility is psychologically exhausting for investors and economically damaging for businesses trying to plan. The unpredictability itself became a drag on economic activity as firms adopted wait and see postures rather than committing capital to expansion or hiring. By mid-April, the administration began to recognize that the market reaction was more severe and sustained than anticipated, facing mounting pressure from business leaders, lawmakers, and even some within his own party. Trump announced a 90-day pause on certain tariff increases. The announcement triggered one of the most dramatic single-day rallies in stock market history. Indices surged nearly 10% as investors interpreted the pause as a potential off-ramp from the trade confrontation. But the relief was temporary and incomplete. Many tariffs remained in place. The pause applied only to specific categories of goods, and the underlying tensions that had triggered the crisis persisted. The damage had been done not just to portfolios, but to something more fundamental. Confidence in American policy, stability had been shaken. The perception that the United States represented a reliable partner in global commerce had been undermined, and questions had been raised about whether the institutions designed to check executive power could function effectively when confronted with a president willing to invoke emergency authorities to bypass normal constraints. The financial architecture that underpins modern capitalism depends on trust more than any other single element. When investors allocate capital, they operate on assumptions about policy continuity, institutional reliability, and governmental competence. Those assumptions are not luxuries. They are prerequisites for the efficient functioning of markets. What transpired during the spring of 2025 was a stress test of those assumptions, and the results suggested that the foundation was less solid than many had believed. Consider the position of a typical American investor in early April. Perhaps you had built a retirement portfolio over decades of careful saving. Perhaps you had diversified across stocks and bonds, following conventional wisdom about risk management. Perhaps you had trusted that while markets fluctuate, the underlying system remained stable. Then, within the span of a few trading sessions, you watched a significant portion of your wealth evaporate. The stocks fell, the bonds fell. The diversification that was supposed to protect you failed because both asset classes moved in the same direction simultaneously. This was not supposed to happen according to the textbooks and the historical patterns that advisors had relied upon for generations. The psychological impact of such an experience cannot be overstated. Investors who had weathered previous market downturns found this episode different in character. Previous crises had external causes. The financial collapse of 2008 stemmed from systemic failures in mortgage markets and banking regulation. The pandemic crash of 2020 resulted from a global health emergency that forced economies into lockdown. But the April 2025 crash was self-inflicted. It resulted directly from policy choices made by elected leaders There was no external villain to blame, no unforeseeable catastrophe to point toward. The chaos originated from decisions made in Washington and executed with apparent disregard for the consequences that experts had warned about. This distinction matters because it shapes how citizens view their government and its capacity to manage economic affairs. When markets crash due to external shocks, there is room for leaders to rally the nation, to coordinate responses, and to demonstrate competence in crisis management. But when the crisis originates from policy choices that ignored widespread warnings, the dynamic shifts. Citizens begin questioning whether their leaders possess the judgment necessary to steward the economy. They wonder whether ideology has overtaken pragmatism. They ask whether the people making decisions understand or care about the real world effects of those decisions on ordinary families. The business community found itself in an impossible position during this period. Chief executives who had spent years building global supply chains suddenly faced costs that made their business models unsustainable. Manufacturers who had optimized production across multiple countries discovered that tariffs had rendered their operations uncompetitive. Retailers who operated on thin margins learned that price increases necessitated by tariff costs would drive customers away. These were not abstract problems. They translated directly into decisions about layoffs, about store closures, about investment cancellations. The human cost of policy uncertainty was mounting even as the administration insisted that everything was proceeding according to plan. Small businesses suffered particularly acute pain. Unlike large corporations with diversified revenue streams and substantial cash reserves, small enterprises operate with little margin for error. When costs spike unexpectedly or when customer demand weakens, they lack the resources to weather extended periods of difficulty. The tariff shock hit them from multiple directions simultaneously. Input costs rose as imported materials became more expensive. Consumer spending softened as households grew nervous about economic prospects. Access to credit tightened as banks became more cautious. And government services they depended on for permits, loans, and regulatory approvals slowed or stopped entirely during periods when political attention focused elsewhere. The agricultural sector faced especially severe challenges. American farmers had spent decades building export markets for their products. Trade agreements had opened doors to consumers around the world who purchased American soybeans, wheat, pork, and countless other commodities. Those markets represented not just current income, but investments in relationships, infrastructure, and long-term planning. When retaliatory tariffs closed off major export destinations, farmers found themselves with products they could not sell at prices that covered their costs. The timing was particularly cruel. Planting decisions for the growing season had already been made based on price expectations that evaporated overnight. Farmers faced the prospect of harvesting crops they would sell at a loss. If they could sell them at all, the technology sector experienced its own form of disruption. Silicon Valley had built an innovation ecosystem that depended fundamentally on global talent, global capital, and global markets. Engineers from around the world collaborated on products sold to customers everywhere. supply chains for components spanned continents, research partnerships crossed borders, the tariff regime and the broader atmosphere of economic nationalism threatened all of these connections. Companies faced decisions about whether to maintain operations in the United States or shift resources to locations with more predictable policy environments. The long-term competitiveness of American technology leadership was suddenly a live question rather than an assumed constant. Financial institutions occupied a particularly complex position as intermediaries in the economic system. Banks and investment firms were simultaneously victims of the market chaos and targets of public anger. Their stock prices fell along with everyone else's. Their trading desks struggled to manage unprecedented volatility. Their wealth management divisions fielded calls from panicked clients demanding explanations and reassurance. Yet they also faced criticism for not having warned clients adequately, for having been too optimistic in their forecasts, and for profiting from market turbulence through trading activities. The credibility of financial expertise itself came under question when highly paid analysts had failed to anticipate the severity of the crisis. The bond market developments were particularly ominous for those who understood their implications. When yields on long-term Treasury securities spiked sharply, it signaled that investors were demanding higher compensation for lending money to the United States government over extended periods. This was not a normal pattern during times of stock market stress. Typically, Treasury bonds serve as safe havens. Investors flee from risky equities into the perceived safety of government debt, which drives bond prices up and yields down. But in April 2025, bonds sold off alongside stocks. Yields rose even as equities crashed. This simultaneous movement indicated something more troubling than routine risk aversion. It suggested that investors were losing confidence in the fundamental creditworthiness and policy stability of the United States itself. The dollar's behavior reinforced these concerns. America's currency had long enjoyed a privileged position in the global financial system. It served as the primary reserve currency, the unit of account for international trade, and a safe haven during times of uncertainty. These roles provided substantial benefits to the United States, including lower borrowing costs, greater policy flexibility, and significant geopolitical influence. But the dollar weakened during the April crisis rather than strengthening as would be expected during a flight to safety. Foreign investors appeared to be reassessing whether dollar-denominated assets deserved their traditional premium. The potential erosion of the dollar's reserve currency status represented one of the most serious long-term threats emerging from the tariff policies. Currency markets are forward-looking. They price in expectations about future economic performance and policy trajectories. When the dollar weakened amid the tariff chaos, it reflected judgments that American economic prospects had deteriorated relative to other major economies. It suggested that the policy environment had become less attractive to international capital, and it raised the possibility that decades of dollar dominance might be approaching an inflection point. Other nations had long chafed at American financial hegemony and sought alternatives. The crisis provided ammunition to those arguing that the global economy needed to reduce its dependence on dollar-based systems Central banks around the world watched these developments with growing alarm. The Federal Reserve faced an impossible dilemma. Normally, during market crashes, central banks cut interest rates to stimulate economic activity and calm investor fears. But the tariff-driven inflation threatened to push consumer prices higher, which would typically call for tighter monetary policy rather than looser. The Fed found itself caught between conflicting mandates. Should it prioritize financial stability by supporting markets, or should it focus on price stability by guarding against inflation? The traditional tools of monetary policy were poorly suited to addressing a crisis that combined elements of both economic contraction and inflationary pressure. International central banks faced their own challenges. European authorities worried that American tariffs would drag down growth across the Atlantic. Asian central banks fretted about currency volatility and capital flight. Emerging market economies saw their borrowing costs spike as investors fled toward perceived safety. The interconnectedness of the global financial system meant that a crisis originating in Washington could not be contained within American borders. It rippled outward, creating stress points throughout the international economic architecture. The real economy effects began manifesting as the financial crisis deepened. Consumer confidence plummeted as households watched their savings diminish and worried about job security. Spending on discretionary items fell as families adopted more cautious financial postures. Business investment plans were shelved as executives concluded that the economic outlook had become too uncertain to justify major capital commitments. The feedback loops between financial markets and the real economy started reinforcing each other in negative directions. Market crashes reduced wealth, which reduced spending, which weakened corporate earnings, which justified further market declines. Employment effects emerged more slowly, but were no less real. Companies that had been considering expansion reversed course. Hiring freezes became common as managers sought to preserve cash and avoid commitments they might need to reverse. In sectors hit hardest by tariffs and retaliation, layoff began. Manufacturing plants dependent on exports found themselves with excess capacity. Retail chains facing cost pressures and weakening demand announced store closures. The unemployment rate, which had been historically low, began ticking upward. Each percentage point increase represented hundreds of thousands of families facing financial insecurity. The political ramifications intensified as the economic pain became more widespread and visible. Town halls became forums for angry constituents demanding answers from their representatives. Business groups that had traditionally supported Republican economic policies found themselves at odds with an administration pursuing tariffs that harmed their members. Agricultural states that had voted overwhelmingly for Trump saw farmers facing bankruptcy. Manufacturing regions that had embraced his message of bringing back jobs watched those same jobs disappear as retaliatory tariffs closed export markets. The political coalition that had brought Trump back to power began showing signs of strain under the weight of economic reality. Democratic opposition seized the opportunity to prosecute a case against Trump's economic management. They highlighted the wealth destruction, the job losses, and the damage to American credibility abroad. They presented the crisis as a case study in the dangers of impulsive leadership untethered from expertise or institutional constraints. They drew connections between Trump's dismissal of economic advisors who had warned against extreme tariff policies and the disastrous outcomes that followed. The narrative they constructed was one of avoidable catastrophe, of warnings ignored, and of ideology prioritized over pragmatism. Yet Trump's core supporters remained largely loyal despite the economic turbulence. They accepted his framing that short-term pain was necessary for long-term gain. They believed his promises that American manufacturing would return and that the economy would ultimately emerge stronger. They viewed the market chaos as evidence that entrenched interests were resisting necessary change rather than as proof that the policies were flawed. This divergence in interpretation of the same events highlighted the deep polarization that characterized American politics. People were not just disagreeing about policy preferences, they were living in different informational ecosystems that shaped their understanding of basic economic reality. The media landscape contributed to this fragmentation. Conservative outlets emphasized stories of American planning to reshore production in response to tariffs. They highlighted examples of deals Trump negotiated with individual countries to reduce trade barriers. They framed the market volatility as temporary and driven by speculators rather than reflecting fundamental economic problems. Liberal media focused on job losses, rising consumer prices, and warnings from economists about recession risks. They featured interviews with struggling business owners and workers facing layoffs. The result was that Americans consuming different media sources came away with radically different understandings of whether the tariff policies were succeeding or failing. Academic economists found themselves in an unusual position of near unanimity about the tariff policies. Across the ideological spectrum, from left-leaning progressives to free market conservatives, professional economists warned that the tariff approach would reduce economic efficiency, lower living standards, and risk triggering recessions both domestically and globally. Studies and models consistently showed negative effects on growth, employment, and consumer welfare. Yet this expert consensus had limited impact on policy or public opinion. The administration dismissed academic criticism as out of touch with real-world concerns. Supporters viewed economist warnings as establishment bias against disruption. The disconnect between expert analysis and policymaking revealed something troubling about the relationship between knowledge and power in contemporary governance. Historical parallels became frequent reference points in discussions about the crisis. Analysts invoked the Smoot-Hawley Tariff Act of 1930, which raised American tariffs to record levels and is widely believed to have deepened and prolonged the Great Depression by triggering a collapse in international trade. They pointed to more recent episodes of trade conflict that had damaged economic growth without achieving their stated objectives. The lessons of history suggested that trade wars were easy to start but difficult to control and costly to all participants. Yet the administration's view was that historical comparisons were inapt because previous leaders had lacked the will to see tariff policies through to successful conclusions. The crisis exposed fundamental questions about executive power and institutional constraints. Trump had invoked emergency economic authorities to impose tariffs without congressional approval. These authorities had been intended for genuine national emergencies, not for pursuing trade policy preferences that could have been addressed through normal legislative processes. The willingness to stretch emergency powers to their limits raised concerns about the erosion of checks and balances. If a president could unilaterally restructure American trade policy by declaring an emergency, what other areas of governance might be subject to similar executive expansion? The precedent being set had implications far beyond trade. Globally, the crisis accelerated conversations about alternatives to the American-led international economic order. China positioned itself as a defender of free trade and multilateralism, a remarkable reversal given its own history of protectionism. European leaders discussed greater economic integration and reduced dependence on American markets and institutions. Regional trade agreements that excluded the United States gained momentum. The post-World War II architecture that had placed America at the center of global commerce was being questioned not by adversaries seeking to overthrow it, but by allies seeking to insulate themselves from American unpredictability. The damage to American soft power was substantial and potentially long-lasting. For decades, the United States had promoted open markets, rule-based trade, and international cooperation as core principles of the global order. American credibility in advocating these principles rested partly on its own adherence to them. By abandoning multilateral trade frameworks and embracing unilateral protectionism, the Trump administration undermined its ability to shape international economic governance. When American representatives argued for rules-based systems, other nations could point to American actions that violated those same principles. The inconsistency between rhetoric and behavior eroded the moral authority that had amplified American influence beyond its raw economic and military power. Continuing to unfold through late spring and into summer, the crisis entered a new phase characterized more by adaptation than panic, but no less consequential for that shift in tenor. The adaptation took forms that revealed just how profoundly the landscape had changed. Companies that had spent decades optimizing global supply chains began the painful process of reconfiguration. Executives huddled in conference rooms, mapping out scenarios that would have seemed unthinkable months earlier. Should they absorb the tariff costs and accept lower margins? Should they pass costs to consumers and risk losing market share? Should they relocate production facilities entirely, abandoning investments that represented years of strategic planning? None of these options were attractive. All carried substantial risks, but inaction was not viable either when cost structures had been fundamentally altered by policy decisions made thousands of miles away in Washington. The reconfiguration process was neither quick nor cheap. Manufacturing operations cannot be moved overnight. Supply relationships built over years cannot be replaced with a few phone calls. Quality standards and production expertise do not transfer instantly across borders or back to domestic facilities that may no longer exist. The tariff shock created immediate cost pressures, but the solutions required time and capital that many firms lacked. The gap between when costs hit and when adjustments could be completed created a period of acute vulnerability for businesses operating on thin margins. Workers bore much of this adjustment burden. Factory employees discovered that their jobs were less secure than they had believed when global trade patterns could shift so dramatically. Office workers in supply chain management and procurement faced pressure to deliver solutions to problems that had no easy answers. The stress filtered through entire organizations as everyone understood that the old playbook no longer applied and the new one was being written in real time under crisis conditions. Morale suffered, productivity declined. The human toll of economic disruption was playing out in break rooms and kitchen tables across the nation. Investors, meanwhile, were forced to recalibrate their entire framework for assessing risk. The traditional models that guided portfolio allocation had assumed a degree of policy stability that no longer existed. How do you price equities when trade policy can reverse course with the single presidential announcement? How do you evaluate bonds when the safe haven status of Treasury securities comes into question? How do you hedge currency risk when the dollar's role in the global system appears less certain? These were not academic questions for professional money managers. They were practical problems that demanded answers because clients expected their savings to be protected and grown. The reassessment extended beyond immediate tactical concerns to fundamental strategic questions about American economic trajectory. Portfolio managers who had overweighted American assets based on assumptions about continued growth and stability began questioning those positions. International investors who had viewed the United States as the safest destination for capital started exploring alternatives. The flow of investment dollars that had long favored American markets showed signs of shifting toward other destinations perceived as offering more predictability, even if they offered lower returns. Capital is mobile. It flows toward environments where the rules are clear and consistently applied. When those conditions erode, capital flows elsewhere, regardless of patriotic sentiment or historical patterns. The Federal Reserve found itself navigating treacherous waters with limited tools and conflicting signals. The traditional playbook called for cutting interest rates during economic slowdowns to stimulate activity, but inflation pressures from tariff costs complicated that calculus. If the Fed cut rates aggressively, it risked allowing inflation to become entrenched. If it maintained higher rates to combat inflation, it risked deepening the economic contraction. The central bank attempted to thread this carefully calibrated moves and extensive communication about its thinking, but markets remained skeptical that any monetary policy response could fully offset the damage from trade policy decisions. Fed officials found themselves in the uncomfortable position of publicly expressing concerns about fiscal and trade policies while trying to maintain the appearance of political independence. Central bank credibility depends on being perceived as above partisan politics. Focused solely on economic stability and the dual mandate of maximum employment and price stability. Yet when government policies were themselves creating economic instability, silence seemed like complicity. The careful language of Fed statements began including more pointed references to policy uncertainty as a headwind to growth. These were as close to direct criticism as the institution could come without crossing lines that would compromise its independence. International economic forums became venues for unprecedented friction. The annual meetings of institutions like the International Monetary Fund and World Bank had traditionally been occasions for coordination and cooperation among major economies, but the spring gatherings following the tariff shock were marked by tension and recrimination. American representatives faced pointed questions and thinly veiled criticism from counterparts who had seen their own economies damaged by Washington's unilateral actions. The multilateral consensus that had guided global economic governance for decades was fracturing in real time. European finance ministers expressed frustration that they had not been consulted before. Policies were implemented that would inevitably affect their economies. Asian officials questioned whether the United States remained committed to the open trading system it had championed for generations. Representatives from developing economies noted bitterly that they were being forced to choose sides in a trade conflict not of their making. The diplomatic damage extended beyond economics into security relationships as allies questioned whether a nation so willing to disrupt economic partnerships could be trusted to honor defense commitments. China emerged from the crisis in a stronger relative position, significant economic damage itself. Beijing had responded to American tariffs with a combination of retaliation and strategic patience rather than matching Trump's rhetoric with inflammatory statements of their own. Chinese officials adopted a pose of mature restraint. They emphasized their commitment to multilateralism and open markets, even as they imposed counter tariffs. They accelerated efforts to develop domestic alternatives to American technology and to build trading relationships that bypass the United States. The crisis provided Beijing with opportunities to position itself as a more reliable partner than Washington, a narrative that found receptive audiences in many capitals. The technological dimension of the confrontation carried particular long-term significance. American leadership in advanced technologies had been a cornerstone of economic and military power for decades. Silicon Valley's innovations had shaped the digital age and created enormous wealth, but that leadership rested on global networks of talent, capital, and markets. The tariff regime and broader climate of economic nationalism threatened all three pillars. Foreign students who had flocked to American universities began considering other destinations. International investors grew cautious about committing capital to American tech startups when market access could be suddenly restricted, and companies faced pressure to localize operations in ways that fragmented the global innovation ecosystem that had been so productive. The semiconductor industry illustrated these tensions with particular clarity. Chip manufacturing is perhaps the most globalized industry in existence. Design often happens in one country, fabrication in another, assembly in a third, with components and materials sourced from dozens of locations worldwide. The tariff shock disrupted these intricate supply chains and raised questions about their viability. Both American and Chinese policymakers had identified semiconductor independence as a strategic priority, leading to massive subsidies for domestic. But the reality was that true independence remained years away and might never be economically feasible, given the enormous scale advantages of concentrated production. The race to secure semiconductor supply chains became a focal point of economic competition, with implications extending far beyond the chip industry itself. semiconductors are fundamental inputs to virtually every modern technology, from smartphones to automobiles to weapon systems. The country or bloc that controlled chip production would wield enormous leverage. This recognition drove policy decisions on both sides of the Pacific that accelerated the decoupling of American and Chinese technology ecosystems. The bifurcation created inefficiencies and raised costs, but both governments concluded that strategic autonomy justified the economic price. American businesses found themselves caught between conflicting pressures. Government policy pushed them toward reducing exposure to Chinese markets and supply chains. But commercial logic pointed toward continued engagement with the world's second largest economy and a critical node in global manufacturing. CEOs faced impossible choices between complying with political expectations and serving shareholder interests. Many attempted to hedge by maintaining presence in both markets while reducing dependencies. But this middle path was expensive and might not be sustainable if the confrontation deepened further. The consumer impact of the tariff regime became increasingly visible as months passed. Retailers had initially absorbed some tariff costs to avoid raising prices, hoping the policies would be temporary. But as it became clear that higher tariffs were persisting, companies began passing costs along. Price increases appeared across categories, from electronics to clothing to household goods. American families found their purchasing power eroded not by traditional inflation driven by excess demand, but by policy choices that functioned as a tax on consumption. The political consequences of this price pressure would take time to fully materialize, but polls showed growing public concern about the housing market. Felt secondary effects as economic uncertainty caused potential buyers to delay purchases and mortgage rates remained elevated. Construction activity slowed as builders faced higher costs for materials and greater difficulty securing financing. Real estate had been one of the bright spots in the American economy, but the tariff shock and resulting financial volatility dimmed those prospects. For many Americans, home equity represented their largest asset and primary source of wealth. When housing markets softened, it affected consumer confidence and spending behavior across the economy. State and local governments confronted budget pressures as economic weakness reduced tax revenues while demand for services increased. States dependent on industries hit hard by tariffs faced particularly acute challenges. Agricultural states dealt with falling farm incomes that reduced sales tax collections. Manufacturing states saw property tax revenues decline as factories reduced operations or closed entirely. At the same time, demand rose for unemployment benefits, social services, and other safety net programs. Governors and mayors found themselves making difficult choices about which services to cut and whether to raise taxes during an economic downturn. The education sector experienced its own form of disruption as international student enrollment showed signs of declining. Foreign students had long been a significant revenue source for American universities, particularly at the graduate level in science and engineering programs. But the combination of visa uncertainties, rising costs, and perceptions that America was becoming less welcoming caused many talented students to consider other destinations, Australia, Canada, and European nations actively recruited students who might previously have automatically chosen American institutions. The long-term implications for American research capacity and innovation were troubling, given how dependent universities had become on international. Healthcare systems faced cost pressures from multiple directions simultaneously. Medical devices and pharmaceutical ingredients often came from overseas suppliers now subject to tariffs. Hospitals operating on tight margins found themselves squeezed between rising input costs and limits on what they could charge for services. Rural hospitals, already financially fragile, before the crisis found their situations becoming untenable. The irony was bitter that trade policies justified partly on national security grounds were undermining the healthcare infrastructure that was itself a component of national resilience. The agricultural sector's struggles deepened as the initial shock gave way to sustained pressure. Farmers had hoped that retaliatory tariffs would be temporary and that export markets would reopen quickly. But as weeks turned to months, it became clear that market access, once lost, would not be easily regained. Competitors from other countries had filled the gaps left by American products. Relationships with overseas buyers that had taken years to build were severed. Even if tariffs were eventually reduced, the damage to American agricultural exports would persist as buyers had diversified away from dependence on American suppliers. Farm bankruptcies began ticking upward, continuing a trend that had started before the tariff crisis, but now accelerating. Family operations that had survived for generations faced impossible economics. Land values in agricultural regions declined as the income potential of farming deteriorated. Rural communities that depended on agriculture as their economic foundation confronted existential challenges. The social fabric of these areas frayed as young people left for opportunities elsewhere, and services disappeared as the customer base shrank. The political geography of agricultural distress created particular challenges for Republicans, given that rural areas had been among Trump's strongest bases of support. Farmers had voted overwhelmingly for him based on promises to fight for their interests and to challenge the urban and coastal elites they believed had ignored them. But the tariff policies were devastating their livelihoods in ways that were impossible to as temporary adjustments. The cognitive dissonance between continued political loyalty and economic reality created tensions that local Republican officials struggled to manage. Some farmers remained steadfast in their support, accepting Trump's argument that short-term sacrifice would yield long-term gains. Others grew increasingly bitter, feeling betrayed by policies that seemed to ignore expert warnings and to prioritize ideological goals over practical consequences. The fractures within agricultural communities reflected broader divisions about whether the tariff approach represented principled toughness or reckless incompetence. These were not abstract political debates. They were arguments about survival happening around kitchen tables and at farm co-op meetings across the heartland. Manufacturing presented an even more complex picture because the sector had been central to Trump's political message. He had promised to bring back factory jobs, to reverse decades of deindustrialization, to make America a manufacturing powerhouse again. The tariff policies were supposed to advance these goals by making imported goods more expensive and thus encouraging domestic production. In some narrow cases, this logic appeared to be working. Certain companies announced plans to expand American facilities or to bring production back from overseas. These announcements received prominent attention from the administration as vindication of the tariff strategy, but the broader manufacturing picture was far less encouraging. Many factories depended on imported components and materials that were now subject to tariffs, raising their costs and making them less competitive. Export-oriented manufacturers faced retaliation that closed overseas markets. Industries with complex supply chains found themselves unable to quickly substitute domestic inputs for imported ones even when they wanted to do so. The net effect in many cases was that American manufacturing became less competitive rather than more so. Employment in the sector showed signs of weakening rather than strengthening as the tariff regime persisted. The story we've traced through these events is not simply about markets rising and falling, about policies implemented and reversed, about wealth created and destroyed. It represents something more fundamental about governance, about the relationship between power and responsibility, about the cost of treating economic policy as performance rather than stewardship. The chaos that erupted in April of 2025 was not inevitable. It resulted from choices, and those choices revealed uncomfortable truths about how decisions get made at the highest levels of government and who bears the consequences when those decisions go wrong. What we witnessed was a stress test of institutions, of markets, of alliances, of the assumptions that underpin modern economic life. Some elements proved more resilient than expected. Others revealed fragilities that will take years to address. The full reckoning has not yet arrived. We are still living through the aftermath, still discovering the second and third order effects of decisions made during those turbulent months. The trajectory ahead remains uncertain, shaped by choices that leaders and citizens will make in response to lessons that are still being absorbed. For anyone watching these events unfold, the takeaway should not be despair, but vigilance. Markets will recover, economies will adapt, but the damage to trust, to credibility, to the predictability that allows societies to function smoothly takes far longer to repair. The question facing us is whether we learn from this episode or whether we normalize the chaos as simply another chapter in an ongoing story. That choice will determine whether April of 2025 becomes remembered as a turning point toward greater stability or as merely the opening act in a longer period of disruption. The answer lies not just in Washington, but in how citizens hold power accountable and demand governance that serves the public rather than spectacle that serves ambition.